And I think, it's unfortunate with the weathermen, meteorologists, they're allowed to be wrong when it comes to market. Well, actually, you know what? The talking heads on TV, they're allowed to be wrong as well, but it's less fun than if they get the weather incorrect and you forget your umbrella. If you are exposed in the market, then it becomes a giant problem. And honestly, the amount of money lost in retirement plans this year, it's gut wrenching. Economists say that inflation and its impact on the market, taking an average of 25% off of American 401ks, which is an estimated total of about $2.1 trillion. So while the experts try to decide if the market has reached a bottom or not, can this also present an opportunity, guys? If there is a new bull market out there, can you help the listeners and clients find it?
Yeah, if you go down to the basics of investing, you buy low and sell high. So, when markets present opportunities or where you want to take advantage of some stuff, I know as you talk about it becomes a little bit more difficult, when it's investing, your emotions are involved. And, I was talking in our meeting this last week going over, things that America is facing, whether it's inflation's continue to be out of control. You have the issues about the downturn in the economy with the markets. We've got conflict overseas that is seeming like it's escalated. With Americans doing some things that they haven't done to prepare for, what could be conflict overseas. And, people oftentimes will wonder, is it time to invest? And, what should I do in a market crash? If I go back and I look at it in October of 2007, before really what I would consider the last big crash, the S&P hit a high of 1,549. So a little over a year later, the investment would have been cut in half. So, today the stock market trades at around 36.85. By not panicking, your money still would double. So even if you had invested at the top of the market back in 2007 before the huge crash happened, by being a patient investor, it proved that over time the market paid off. If you decided to invest back in January 2020, when we had COVID happen, right before the crash, the S&P had hit 3,225. A few months later, the market was down nearly 40%. And even after the market recent crash here in 2020, the market's still about 14% higher than when it had topped out back in January of 2020. So one thing that you have to take into consideration is you cannot invest directly into the S&P 500 index, but what you can see is that time and time again, the stock market has rewarded investors even when they seem to be buying at the worst possible time. Yet here we are in 2020, going into the last quarter of the year, and the stock market is down, 25 to 30%, depending upon which index that you look at and what day that you look at it. If you have time on your side, it can be a great opportunity to buy stocks. I think one of the key things that I would encourage investors and listeners to know is develop your strategy, run the fire safety drill ahead of time, and know exactly what is your methodology when it comes to pick stocks. So here at our office, in our investment portfolios within the Retirement Guys formulas, how we look at stocks is we look at companies, and one of the areas that we like are companies that are very financially sound. So cash-rich companies, companies that have low debt, high return on equity. So by having a defined strategy, I can go and I can filter out different companies that we want to look for based upon what that methodology is. When I think about investing, there's two ways that somebody loses money in the stock market. When you buy an investment, it goes down in price and you sell that investment. And that's a painful lesson that too many investors experience. Right now they panic and they sell out because the market's in a, quote, crash. All that does is that locks in losses, and then they wait until things appear better, meaning that they miss any type of recovery and get back in at a later point. It's a painful lesson that happens over and over again. The other way that you can lose money is by investing in a company and they file bankruptcy. So again, it's some of the models that we have looking at companies that are cash rich, low debt, good return on equity. Hopefully we've tried to identify companies that aren't at risk of going out of business. The other thing that I like, the debate is, are we in a recession? Is the recession already here? Is it coming? When is it going to happen? Regardless of when they actually declare it, I'd say times are a little tough right now.
Absolutely.
But even with times being tough, you still need things every single day. There's still what are called daily essentials. So I like the companies that are daily essential companies that you use every single day within your life. When you get up and use products in the bathroom, when you get dressed and ready to go to work, what you eat for breakfast, where you shop at for your groceries, how you live your life. And those are the type of things that I think can tend to be a little bit more defensive in this type of market. The next question is determining, when to get in and out. And, at the end of the day, we had our economic summit, one of our most popular events, and people come out and they want our opinion of, what do we think the market's going to do, say, after the election. Well, we're willing to give our opinion, but at the same time, I would say the market doesn't care what our opinion is. If you have a predetermined strategy, and again, if you stick to that, that can be a way that I think personally over time, it can increase the odds of being successful. So as an example, if the market goes down greater than this percentage, that's when you maybe would add more because you're buying at a lower point. The same would be true as if you look at technical analysis and determining when to get back into the market. If you're already a little bit defensive, some of our strategies like iron retirement and our ISERT circuit breaker, what we do is we look at technical analysis to determine whether it's a good time to get back into the market. So it's kind of like, pushing the gas pedal down. Sure. When things technically look negative and we're below certain moving averages, we're kind of letting off the gas pedal, maybe reducing our equity exposure, which is what those portfolios did, back when the markets had some breakdown. And then when the markets go back above some of those technical levels, we'll push the gas pedal back down, thus increasing our equity position. So those are the reasons why you want to take a look at having a defined investment process. And those can be some great ways that can help you as an investor to determine, is it smart to buy stocks during a crash?
Nolan, it's like going to the casino, right? You have a certain amount of money in your pocket and you're willing to lose that certain amount of money, right? But you're winning and you're winning and you're winning. At what point do you decide I'm cashing out, right? So I guess if I were to invest when the market is low, that's not to say that it's not going to drop a little bit lower, right?
Absolutely.
I mean, if I put in, and let's say my threshold is at a certain number and that number hits and I buy, that's not to say that it might not even go lower than that, but my gains are going to be so much higher because I'm buying lower. How often do you run into those questions? How do you, it's almost impossible. We don't have crystal balls sitting here, right? How do you know when? And like you said, with your systems that you got put in place is a good way to help at least guide through that.
Well, I mean, you can use history as a guideline. So history would be helpful to be able to make some of those decisions. So on any given day, if you look at historical numbers, it's roughly a 50-50 chance whether today the stock market's going to be up or down. Mm-hmm. The longer you go, if you go 1 year, the odds increase. If you go 3 years, if you go 5 years, the odds increase. So, for those of you that are longer term investors, and for those of you, even if you're at retirement time, if you have a bucket of money that's designed to help offset inflation and, be there for the long term, and you have the ability to let that money have time on your side, just as I started out, even the person who invested at what would have appeared to be the worst possible time, say like sure. October of 2007 before the big 2008 crash, by sticking it out and being a longer-term investor, it still proved that would be a prudent, smart decision by having time on your side.
I mean, if you've got the stomach for it, the market always does seem to come back and come back stronger. But what do you do in the interim? I mean, obviously, if you are retired in October of 2007 and the market goes down, you don't really want to compound those losses. This is where having a diversified strategy comes into place, where it may not necessarily all be tied into the market. Obviously, there is money over the course of a 20, 30-year retirement you're not going to need for 10, 15 years. That is money you can certainly keep in the market. But what to do in the interim, well, that comes down to having a proper strategy put in place. And that is what you get with the team at America's Retirement Headquarters. The Retirement Guys formula, America's Medicare Associates. Start developing that plan, especially if you're getting closer and closer to retirement. If you're nervous about how the market is performing right now, start developing a plan. Take that emotion out of it. It all starts 419-794-3030 is the phone number. Once again, 419-794-3030, or just go online, schedule the time there as well. Americasretirementheadquarters.com. Don't forget the events tab over there at America's Retirement Headquarters if you want to get more information, including how to go ahead and reserve your seat for the upcoming Baby Boomer Basics class coming up mid-November. That's at Americasretirementheadquarters.com.